Hello everyone, welcome to the learning session of Trade Ops. So today we will be discussing about moving average. So without wasting much time, let us directly start with the session. But before proceeding into the session, let us have a walkthrough of the key points which we will be discussing throughout the video. The very first point is what is a moving average and why do we need it? Then we'll be covering the types of moving average and how are these moving averages calculated. Next, we'll also see how moving average can act as a support and resistance. So I am pre-assuming throughout the session that you guys are already aware about resistance and support. But if you guys are not aware for resistance and support, you can surely ping in the comment box. I'll surely make a separate video for resistance and support in detail. We would also go through some of the common moving averages which are used, and I'll also guide you on when and how to use this moving average. So I hope you'd be clear with the key points which we'll be discussing. So let us move further into the session. Okay, so what is a moving average? Basically, a moving average is created by a series of averages of different subsets. So these subsets can be, let's assume, a series of, let's say, 5 sets, 10. So basically, we call it 5 SMA, 10 SMA, or 5 EMA. I'll explain these further that what are these SMA and EMA. So it can be of any particular set, right? So whatever set you choose, it will be a series of those averages, and basically we use these moving average to remove the noise in the fluctuations which happen in that short term period, right? And also it is a lagging indicator. Now what is this lagging indicator? Basically lagging means late. So just if we go on the name also, we'll understand that it is a late indicator, which means post the movement, once the movement occurs, post the movement this actually works. But it doesn't mean that, like, since it is a lagging indicator, it's of no use for us. No. uh, to be honest, like, moving average is one of my favorite indicator, and I personally feel that its accuracy can be easily maintained, provided we keep in mind some points. So I'll surely reflect on those points, that how can we actually use this in a very good manner. And despite being a lagging indicator, we will see that it can be very useful for us. So now let us understand with from my example what a moving average is. So let's assume that I have a set of 10 numbers, 1 2 3 4, and being a like, you can take this in a mathematical manner also, or if you wish, you just understand that these are the stock prices of each day. So on day 1 the price was, let's say, 1 rupees. Next day the price went to 2 rupees, then 3 rupees, and further. So on the 10th day the price was 10 rupees. So just assume like this. Now as I told you that it is of different subsets, right? I told you here. So let's assume I am taking a subset of 3. So first I'll find out, let's assume that I want to find the average of these 3 numbers in the very beginning. So for the first 3 numbers, what would be the average? It would be 2. We know the basic simple average calculation rule, right? 3 plus 2 plus 1 divided by 3, like, since it's for 3 numbers. So 6 divided by 3, we get 2. Now let's assume that I want to take next subset. So next subset, let's assume I want to take this 3, 2, 3 and 4, right? So for these 3, again, if I take the average, what would be the average? It would be 3. It's basic maths, you can check that. Again, now let's assume I want to take for these 3, 3, 4 and 5, this one. So for this one, again, the average would be 4, and so on. Like, again, if you will take for the next one, which is basically 4, 5 and 6, the average would be 5. You can calculate that out. So 2, 3, 4, 5, this would be the way how the average would be. Now these are the averages which I got for each subset, right? So basically what I am doing is, out here I am excluding these digits as I am moving further forward, and the same way it works in stock market also. Okay, so basically if I'm taking a 3 days moving average, what happens is for the first 3 days these three would be used. Next day one day increases, so that would be used the last day before that one and the day before yesterday. So basically in that manner, so if this is the current day, the 3 days would be these three, right? So the this would be a subset, the last subset, right? So basically if you plot this in a chart, right, like now I know I got three datas, 2 3 4, then the next data would be 5, right? This, so if I want to plot this on a chart, now this is a chart. So here basically on day one I took for these three, so here I got 2, then the next I got 3, for the next I got 4, the next I got 5, and so on, right? So this is the moving average which I got. So can I say that after 10 days, if I'll plot this further like this, let's assume, so this will be a chart which will be following for 10 days as well. If I go for this manner, and if this is the price how it is increasing, generally this is not the manner in which the stock prices increase. You will see something like this 1, then the next day it was 1.2, next day it came down to, let's again assume again to 1, next day it went up to 1.5, right? Then next day again it went to, let's assume directly it went up by good amount, so by up to 3 directly. The next day maybe it came down again to, let's say 2. So this would be the way basically how the stock market would be working. So in this manner also, if you'll take the averages, and if you'll in the similar manner if you'll plot a chart, you'll get a chart out here as well. So this is the meaning of this series of averages. This is how the series of averages came, and this is how we actually plot in the moving average. So this is why this is what actually a moving average is. So I hope you would be able to plot a moving average from now, and it doesn't like every broker gives you a tool to basically plot a moving average, so you don't have to plot this manually. But for example, that if you ever in future, like if you are not given any tool and something, you just want to note it down in the paper, you can do that by this method as well. So I have tried my best to explain you from the base level that how basically a moving average came into existence and how it was actually working, right? Now let us move to why do we need moving average. Okay, the very first point is moving average helps us to determine the correct entry into the market with a a higher accurate levels. Like using this moving average, I'll get a point. I'll understand that if I take an entry at this point, this level, that level would be actually highly accurate. So the probability of failing, like if I am seeing that there is a, just assume that I am seeing that there is a confirmation which I got that now the stock will fall, right, from this level. Let's assume that from a level of the stock is moving in this direction, and from a level I saw that now it is going to fall. So basically if I get a good confirmation out here, right, so of this falling, so this entry which if it is supported by a moving average, this entry would be a very highly accurate entry. The chances of failing in this entry is very less. But let's assume this is a market, by chance this stock goes up and I fail. That's what actually a market is all about. So basically if I fail, in that case also moving average will help me there as well. It will give me a stop loss as well, that which point it will help me to understand a stop loss, that if even if I fail, though it gave me a high accurate entry point, that you should enter here, the chances like it's 80 to 90% accurate that it will basically go in your favor. But even if it doesn't go in my favor, moving average will help me to understand a stop loss as well. So I even have a stop loss, so even if it hits the stop loss, I'll be saving my loss, right? And the third and the most important one is I can use this for resistance and support as well, right? So you would have seen in the very first picture how I can use it. So if you can see in this diagram also, this is how it acts as a support here. So this is basically a support in which it is acting. So basically whenever it shows a price upward from this support, like it touches this and from here it shows a closing price on the next candle on the upward direction, I can do a buy. If I see a closing above this support and it's showing a reversal, so basically you can see all these points from where I could have taken a buy, right? So maybe from here, maybe from here, maybe from here, right? So sometimes we see like this is a case where it is acting as a support. Maybe there would be a case where it would be acting as a resistance as well. From that, whenever it touches that point, it falls down. So these are some uh, key areas where basically a moving average is used. Okay, so now we will understand different types of moving average and how are they calculated. So the very first type which we saw is simple moving average, SMA. We have been seeing this like the example which I gave you for what a moving average. There also the example which I gave. These are all simple moving average. Okay, and the other one is exponential moving average, EMA, which we call. Like there are several other types as well. These are the most commonly used ones. Like apart from this also there are others like weighted moving average, smooth and moving average. They are also there, but these two are the most common ones which we basically use. Okay, now what is a SMA? If I'll talk about this, let's talk about SMA, that what this SMA basically is. So for, I'll again take the same example which we took, and if we keep on adding like for 3, then again for these 3, so it will be 3, for these 3, so it will be 4, right? So we have already seen this, and if we plot this in a line, it comes out something like this, 2 3 4, right? So this was simple moving average. We were just using the formula which we know for moving average, right? So the number of terms divided by like the sum of these 3 divided by 3, the basic sum, right? The sum of n terms divided by n. So this is simple moving average. Now what is an exponential moving average? This is something new for us. I didn't went much deeper for SMA because we already know how SMA works. The calculation part we already know. Exponential moving average is something new. So let us dive into it. So for this, the formula is value which currently is, now basically first I'll tell you what it is. So exponential moving average, here the weight of most recent candles is more as compared to the past ones, the older ones. So here if you see the like say for example that today the market all of a sudden went up for around 5 or 6%. So because of a sudden increase in the market, so like generally this was how the market was moving, and today all of a sudden like this movement was seen. So basically what will happen if this was something for a simple moving average, the average would have been something like this only. Okay, and a small increase like this, because that's a moving average, that's a simple moving average where the weight of each day is same, like be it day 4, day 3, day 2, day 1, all the weightage is same. Here in exponential moving average the weight has been deferred. So basically now I am giving more weightage to the recent candles, so this candle has been given more weightage. So like the value today at which the currently the price is trading, and this is the weight percentage, the weight which you are given to it, plus this added with the EMA yesterday. So whatever was the EMA yesterday, that one multiplied by 1 minus that number of percentage again, right? So this is the weight basically which is being given. Okay, so with this formula EMA comes out, like this formula is not needed for us general people. Like if there is any student of CA, or if they are seeing this video, so for them it actually comes, they have to find this theory in a theoretical paper, how EMA works, like the form using the formula. So for them this would be needed. We don't need to go further deep on the formula. Okay, we just need to understand like the basic thing, that here the weight of the most recent candle is more as compared to the older ones. That's it. For us this much information is enough. So now let us take the calculations of moving average with some examples. Okay, so first of all let us understand from an example. So let's assume that today I bought a stock at 100 rupees. So I bought it at 100 rupees, right? So let's assume that tomorrow the stock goes up in, it shows a very good bullish movement and it reaches, let's assume 120. Okay, so it reaches 120. uh, Please note the points, the words which I say, like it gave a bullish movement. So generally I'll be using these terms. So bullish means upward movements, bearish means downwards movements. Like if bullish means it was a profitable journey or upward journey, lost journey or bearish journey or downward journey is referred as bearish. Okay, so it showed a bullish movement from 100 to 120. So if I tell you that no matter what day it was, how many time it took, whatever it took, just tell me that from 100 to 120 if it went, what would be the average? So can the average be here? A general question. Can the average be here? No. Can the average be below this? Something somewhere here? No. The average will be in between 100 and 120 only, right? And you know how to find the average. So the average will be 110. Okay, so the average will be 110. Now take the opposite of this, the vice versa. Now let's assume you bought at 120 and the stock started falling and it came down to, let's assume, 100 again. So in this scenario also, can the average be outside this line? No, it will again be 110 inside the same trend only, like between these two ranges, right? So now the point why I told this example I came is, this is the current market price in a bullish movement. So if the price is going up, the current price is always higher to the average. So this is the average. Okay, so in this, if you will see, this average is below this point, this current market price. Okay, so here this current market price is higher and the average is lower. But in a bearish market, when the prices is falling, in that price, this is the current market price. Okay, so the current market price is this one, and the average, this is your average, this is basically higher, this is above the current market price. So let's recap what I told. I just told that in a bullish market, if the price is going up, the current market price will be higher, the average will be lower, the current market price. In a bearish market, if the price is going down, if the trend is bearish, the average will generally be above and the current market price will be below. In It has to be a confirm, like don't judge this with 1 day or 2 day. If the complete trend of several days, the trend is of bearish or bullish, in that situation this pattern is followed. So let's assume that tomorrow someone tells you, why I actually gave you this example is, these values don't matter. Did they matter here? No, the initial value never mattered. What mattered was the current market price and the average. So tomorrow someone tells you, like this is just for the importance of moving average. So tomorrow if someone comes and he says you that there is a price of a stock which is basically at 125, okay, and the average of that stock is, let's assume, 105. Okay, so 105. So this is your average, this is your average, and this is your current market price. Okay, current price. So can I say, can you tell me the, directly by seeing these two, can you tell me the trend of the market? Like if you'll ask me, I'll say, yeah, the trend is bullish out here because here the average is low and the current market price is high. Okay. The vice versa of this, let's assume that someone comes and he says you that the current market price is 105 and the average is 130, let's say. So in this situation, what will happen? This is above, this is below. Okay, so this is higher, this is lower. So I can say that in this scenario, it is a bearish market. So I hope that you would have understood why this, why did I emphasize on making you understand this point, that how we can determine the overall trend of the market just by seeing, if we are given these two values. Okay, so now let's understand the same thing on a chart. Okay, so this is a chart which I am given. This is basically a chart snapshot which I have taken. So let's assume that in this chart, these are this is the current, like the latest candle which was formed. This is the one. So here, and this green line which you are seeing, okay, so I'll just point them out. This is a SMA, simple moving average, first of all, and this is a 5 day 5 candles SMA. So what does this 5 means? 5 means basically 1 2 3 4 5, a combination of these, okay, till here. These 5, the average of these 5 will ultimately give me 5 SMA. Okay, so like that will be giving me one point of that 5 SMA. If I want to, like I just told you in the beginning only, that we basically, it is a series of several points. So the next point will be basically including this one and excluding this part, right? So it will exclude this one and this one will be included in that. So I'll get the next series. Again, there will be one more candle before this. Let's assume there was a candle here. So if I'll include this one, and so I'll exclude this portion, this candle. So I'll exclude this one, though I'll include this. So I'll, in this way I'll get several series of points, and then when I join these points, so this is the moving average, this is the line which I get from the moving average. Okay, so here let's assume these are the closing prices. So why did I told the closing price? So basically you have to decide, if you don't know about this candle, like this candle basically determines it gives a good information. So this is the opening price, this is closing price, this is high, this is low, and in the red candles only these two interchange. So here this is opening, this is closing, rest remains same. So this will be high and this will be low. Okay, so basically this is a close. You have to decide that which price do you want for your moving average. Okay, so for me I decided that I want to like calculate this on the basis of closing price. So I will just take down the, I'll mark down the closing price. So generally for red candles the closing price will be below this one, and for green candles the closing price will be this higher ones. So I'll just mark them out. So these are the let's assume the 5 points which I need. Why these 5? Why didn't I took this? Because I need a 5 SMA. It is of 5 candles only. So why should I include the sixth one? So 1 2 3 4 5, these 5 are included. So I know, I just told you how to take the moving average, sum of these divided by 5. So I'll take the sum of these. So this is the sum divided by 5. So you can check this sum divided by 5 on your calculator as well. So you will find it to be 422.28. I have already calculated it, and you can see that here also the same value is mentioned, since I have taken the recent one, right? I told you in the beginning only that this is the recent candle. So if we include the recent candle, we can see it on the chart here that yeah, so which means that our calculations were correct, and our concepts are clear, that also correct, that we are going in the right direction, that yeah, this is how the basic SMA works, this is how it is calculated. Now if you don't want to include this candle, let's assume you don't want this candle to be included and you want this bigger candle to be included, so you just include this. So use this one to be in the sum, and remove this 422.2 from here. So if you sum these again, you'll get a value. Now that can be any other value. So for me, I know that value will be below this only. It will be here, somewhere here. Okay, so this will be the value, somewhere around here. So this will be the value. So just check those values or get all the series of values, and you can also plot a line like this. So I hope you would be clear how this plotting works, how the calculation works. So basically I took an example of SMA because it was easier to explain you for SMA. In EMF, basically what happens is the weightage is increased for the front side ones, right? So these candles, the recent candles, like these candles will have a higher weightage, and the old candles, these candle will have less weightage. Okay, so they have high weightage and these have less weightage. So to understand, make you understand of EMA, what I'll basically do is I'll directly move to charts. Okay, so currently I'll be using my own broker. If you guys wish, you can use brokers or TradingView or any other platform. So from there we'll understand from the charts. So let us directly move to the chart. Okay, so this is the chart of SBI, and I'm currently using my broker. So you can view this chart from anywhere, and you can apply studies, be it in TradingView, be it in any other platform, or even the brokers provide you a chart. So you can use moving average from whichever way you are comfortable with. So I'll be using the Zerodha chart platform only. So let's assume like this was the chart screenshot which was seeing there. So here you can see like we got 422.28, right, the moving average, and this is a 5 SMA if you can see the hover, right? So this is a 5 SMA, and here this is a 5 minutes time frame. So yeah, time frame actually plays a good role. So you should understand this, that because of time frame, like here it is of 5 minutes. So currently 5 SMA means 5 candles, 1 2 3 4 5. So totally it is of 25 minutes. So for 25 minutes the point is 422.28. Okay, but now if I move to 10 minutes, let's say, so for 10 minutes 5 candles will eventually be 50 minutes, right? So now for 50 minutes it is 422.62, this average. So for each, because ultimately the rule of moving averages of candles, on the basis of candles, so 5 candles means 5 SMA. So it can be on any time frame. So if it's on 1 day time frame, 5 candles means 5 days. So the average of 5 days is 417.04. okay, so we go on 5 days, right? So let's go on 5 days, and I've already explained you this simple moving average, and it is the easiest way to understand SMA. So SMA is not a big deal, so we have already understood it. Now let's try to understand exponential one. So basically I'll add a new one so that even you can understand. So what we'll do is we'll go to studies here. You can search here moving, so it's already searched. I'll just search moving average. Here by default it comes of 50 days, so I'll write 5 years. So 5 means 5 candles. Okay, this was the field which I was talking about, that currently we are taking closing price, right? So you can select here open, high, low, any other. So we'll keep it as closing. Okay, the other one is simple, so I'll change it to exponential because we already have a simple out there, and simple color was green, so for this let's keep the color as red. The period is correct, so we'll do done. So you can see there is not a big difference on the red, like for it's 422.38. So exponential is 422.38 and the normal one was 422.28. It's hidden here in between, but you already know that we have calculated it as well, right? So in 1 day, if I'll show you, there's not a big difference in 5 days candle. So what we'll do is we'll actually try to increase this. So let's increase this to 200. Done. And the both, like for both the candles, for simple as well as for exponential, and increase it to 200. And if I'll now see this, yeah, there is a very good difference in the price. So like basically the exponential price is at 314.26, whereas the general moving SMA is at 287. So from here you could understand that there is a good difference in this. So now why did this difference came? So as I told you, look, SMA is based on weighted system, and here the weight is of each candle has a equal weight, right? So for 200 days period the weight is same out here, right? So it will react slowly. But for SMA, like let's see the trend as well. So can I say that from here the trend up to here, it is a bullish trend? I hope that you agree with me that by seeing this I can say that it is in a bullish trend. It is running in a bullish trend, right? So in a bullish trend, if I see these candles, these huge growing candles, this one, then this one, so can I say that EMA would have reacted faster because here the weightage of the recent candles are more? So basically the EMA of this area, they'll have small weightage, right, of the older candles. So the candles weightage of these older ones are less and the weightage of these newer ones are more. So eventually the price will react faster, right? That's why it is moving more close to the actual price, and this is reacting slowly. That's why it is a bit far. Okay, so this is one way to understand. Now let's understand this from the March fall. Like this is a very good way to understand. So basically see what happened here. This is red one is EMA and this green one is SMA. So as soon as the market started falling, right, in the March due to lockdown and due to COVID, right? So from the beginning, when it started falling, you can see that EMA, this gap, see the gap, it started increasing and EMA was reacting faster. Like it is more close to the actual price. It started reacting, and this is below the SMA, right? So it reacted faster and it was more coming more close to it, and this SMA was reacting slowly, right? And again now also, as soon as like this was the bearish trend, so in bearish trend I have already told you what happens is that the current market price is down and the moving averages remain on the top, and in bullish market what happens is the current market price is on higher price and the average remains down, right? So here we can predict the the trend as well, that here the trend is of bearish, here the trend is of bullish, right? And because of bearish trend this was reacting faster, so EMA was more close. So I hope that you would have understood that when EMA comes more closer and when SMA comes more closer, right? So this is a general way to understand EMA and SMA. I'm not saying this that this is the only example. We can take any other chart as well. So if you wish, you can take some other chart. So let us take a chart of some. Let's take a happiest minds chart. So here you can see, like here also you will understand that on EMA the gap is again more. Why? Because here the price increased like that drastically upwards. So here it took, because it takes again the same way, so here it took the price of the recent change candles more, uh, so that's why the price is above, right? So generally here when the like here it was in a struggle consolidation, in a struggle phase. So basically in the struggle phase we can see that they were like together on a similar like similar levels, and now as soon as the stock has started moving upwards, now we can see that the gap is also increasing, right? So we can see the same. I'm not sure why it's not showing on the 1 day time frame. Okay, maybe because there are not 200 candles yet, because actually it got listed in September only on the market, so I guess 200 candles are not yet created. That's the reason because why 1 day time frame it's not showing. Anyway, no issues for that. uh, what we can do is um, let me do one thing, like to see like just for you guys to understand, what I can do is we'll make it at 100, let's say. Okay, and this one as well. Done. So in this manner I guess in 1 day I should see, yeah. So this is for 1 day, so you can see it started from here only because the other 100 is not completed. So again you can see there is a gap. So this gap comes because of these. Okay, so like in this also, if you'll see, now currently the price is moving, so exponential moving average will react faster, so it will move a bit on a good speed as compared to this, so it will be reacting slowly, the normal SMA. So I hope that this SMA and EMA rule is, you would have understood them, and basically to be honest there is not a big huge difference in both. You can use any of these. It basically depends on trader to trader. So some traders prefer EMA, some traders prefer SMA. Like some of them likes faster reacting moving average, so for them EMA is made. Those who are means they are okay with this, like SMA is a bit slow as compared to on reacting as compared to the EMA. So if they are, it is fine, they prefer SMA also, because ultimately the price is not, there is not a big huge difference in the price, right? So like if you'll see for like intraday traders, or for them it's almost same. There is not a big difference. See, so why would they go for, they can go for any of these, right? So now this was of 100 candles, so they'll not use this. So I'll talk in detail that when should we use 100 candles, when should we use 200 candles. But for now I hope that you would have understood the difference in SMA and EMA. Well then, now I hope that the use of charts are clear, and we can again return back to where we left, and we'll start exploring the other parts which we have left there, the other topics. Okay, so we have seen the ways on which moving average is calculated and how they how what are the different types of moving average we basically have, right? So now let us understand how these moving average basically act as resistance and support. So I am assuming that you guys are already familiar with resistance and support. Okay, if you face difficulty in understanding resistance and support, just do write in the comment box. I would make a separate video for that. So for now, the basic knowledge which you should have is, I'll just give you an overview that resistance is the point from where the stock falls most of the time consecutively. So let's assume this is the line. Okay, so a stock goes up, it falls down, again it goes up, it falls down. In this manner, the stock moves. So in this way, this point will be called as resistance, this line, because uh, at all these levels, it was touching the line and it was falling from here, right? So this is basically the resistance, the way from where your stock was resisted to go up, right? It faced a resistance and it started falling down, right? So it is basically acting as a barrier, right? And the support is the point where your stock gets a hold and it moves, like it bounces from there up. Okay, so this can be a support here, out here maybe, right? So this can, maybe from here it would go up again. So this could be a support means the point where multiple times this took a support, like it bounced back from there, a reversal was seen basically, right? So this is the general resistance and support knowledge which you should have to understand this concept of moving average, right? So now let us understand this with the same example which we had seen for moving average, this 1 to 10 example, right? Just one second. Okay, so now again let us take the same example, that this 1 to 10 example. So this time I'll not be taking any subsets. Okay, so now what I'll be doing is, let us, we have already seen the different types, right? So I'll just tell you the technical name. This is a 10 SMA. Let's assume that this is a 10 SMA. So what this time in SMA means is, you already know, SMA, a moving average of 10 subsets, right? So this is a 10 subsets moving average. So basically the average of this would be 5.5, right? 5.5 would be the average at which would be coming, and there would be different more subsets of 10, right? Which would be there, like something from 0 to 9, something would be there which would be previously, there would be one more from 2 to 11, and so on, right? Other one would be from 3 to 12. So like these, in this manner it is moving. So if I'll plot this again on my graph, that now there can be some fluctuations, like now I don't want to create a straight graph this time, so I'll make some fluctuations, sometimes up, sometimes down, so that I can get a curve graph this time. So let's assume I got this graph, this curve graph, and this is a graph of 10 SMA, right? So this is the graph which I got. Now um, how to understand, relate this with resistance and support. So generally, to understand this, this resistance and support part, you need to understand the general human mentality, how human we guys actually think, right? And how they act as a supply and demand basically, right? So to understand this, let's take an example of two persons, person A and person B, and this time we'll be seeing the same 1 to 10 points. Okay, we'll be seeing in a different manner. So moving average is all based on your perspective, how you see it. So now I'll explain you the same concept but with a different manner. So I hope that you will explore something new from here. So let's assume a person A buys a stock, any XYZ stock, at a price of rupees 1, and here he bought, let's assume, one quantity of the stock. Okay, so he bought it at rupees 1, and he's a long-term investor generally. So if way back in like 10 years ago, 15 years ago, he had bought this stock at rupees 1. After some years, or some, the stock price came to, let's say, 2 rupees. He again fueled this stock. Okay, so he fueled means he just bought one more stock of that same company. So he bought one more at 2 rupees. Okay, again after some months or years, again the price moved to 3. He again went and he bought one more, and so on, like at 4, 5, 6, he keeps on buying one more, each time the price rises. Okay, so one day the price came to 10 and he again bought one more. So can you tell me what would be the average price which would be seen on his on his holdings. So generally, if you guys have already traded, you know that if you keep on fueling on this way, like if you keep on buying in this manner, your price would not be shown as one now, because at every price there was a stock which was bought, so it will be the average of all those stocks, right? That will be the average price at which currently your market your capital is. So it will be at 5.5 again, right? Because you have bought at all these levels. So your average price of buying would be 5.5. Now you took years to actually come to this level, right? Like 5 years, 10 years, you actually waited, then you came at a price, average price of 5.5, and you are enjoying whatever results you are getting, the profit you are getting, you are enjoying that. Now, seeing this, a person B who is new to stock market, he enters into stock market. Okay, so now let's assume this the time period is February 2020. Okay, so at that time this person entered, and as soon as he entered, March came, and in March the stock started falling down. So the stock was at 10 rupees, and unfortunately the COVID struck, and from that time the stock started falling down. Okay, so now this B person would be this B person was aiming to buy, and he was actually he bought some stocks at 10 price. Now he is very sad. There are several other persons also who are actually following this A, right, the investor A. Now all these persons, they are actually, now they are all worried the market is falling, and this A investor, like even now this B investor is also worried because he had bought at 10 rupees. Right now, you know what will happen? It will start falling. Okay, it will start falling, and it starts falling, and there comes a time when it comes into a zone of, let's say, 5.5 or 5.6. It trades at this level. And why I took the example of February, because at that time most stocks came down by a very good a very good crash was seen at that time. So that's why I took that example. So at that time the stock also came from 10 rupees to 5.6 rupees, let's assume. So now, as an investor, like as a new investor, if apart from this A and B, if there is a C investor or a D investor who is a bit, who has a very a small knowledge also, if he has, or he knows a basic maths also, he can understand that now this A investors price is 5.5 average price. Like after buying one quantity for 5 years, he made it his average price to 5.5, and currently due to this COVID, you are getting that same stock at 5.6 or 5.5 again. So as an investor, you'll definitely buy at this price, because the efforts which he put and the efforts that you are putting, they are getting, ultimately your capital is getting same as that of this person, right? So even you can enjoy the same profit in this term. So this is for like 10 SMA. The same can be for 20 SMA, 30 SMA. There can be different SMAs in which this price would vary, right? So in this graph, the price went up, right? And due to COVID, it started falling, and it came back to, let's assume, this level. This was the 5.6 level. Okay, so here you know that this is the average at which that investor has bought, so you will also buy at this level. So this is a human mentality why you are buying. This is not because of any reason or something. You are feeling that those investors are also holding at this average price. I also should invest in this average price at this level only. So from here the demand increases, and that's the reason why the stock again started rising from this average price. There can be a situation again, like after some levels, if it falls again at from this average, it will again start rising. So this is basically because of the mentality, the way different investors are thinking that even I'm getting the stock at a good average price, where other investors has also averaged their price, right? So this is a reason why the stock bounces back from here. So this was an example where it took as a support, this acted as a support, because here from here the stock bounced back. So this was a support. The same can be for resistance as well. Like in resistance case, what would happen is basically this happens in a market where like your stock price is below the moving average. So generally if your moving average is something like this. Okay, so in this case this would happen like in a bearish market. So in this case what happens is basically like if you are recovering from a bearish market, so in this case what would happen is your price will touch this moving average, because you will feel that like for to understand this bearish one part, right, for this resistance, the I should again take the same example only of this B person, right, this B person, not this B person, A person would be a good example. Okay, so now this A person, he was having a very good profit, he was enjoying his profit, he was seeing his portfolio around 50%, 100%, 200%, 300% up, and suddenly the stock crash came. Now this person is thinking, I wish I would have sold my stock at 10 rupees. Now the stock price came to 8 rupees. Again, he thinks the same thing. I wish I would have sold my stock at 8 rupees or 9 rupees. Again, now the stock fell back to 7 rupees. Again, the person thinks, I wish I would have sold it to at even at 8 rupees also. I don't need 10 rupees. I don't need 9 rupees. Even at 8 also, if I had sold this stock, it would have been a good profit in that scenario as well. But again, his heart doesn't agree with this. He thinks that no, 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 from here also maybe there could be a reversal. Let's wait. Your stock price comes back to 6. Now at 6 you will think, I wish my price would have been I would have sold it at 7 also. Like this your price starts falling, 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 and it falls back to 3 rupees, 2 rupees, right, and from there it shows a reversal. So in this scenario you know what would happen. This is for resistance, guys. Okay, so for resistance what would happen is, from 2 rupees, let's assume this stock is going now. Okay, so from 2 rupees, if the stock goes up and it goes up to this average, that is 5.5, now this investor who took this opportunity at again buying at 2 rupees as well, again some amount, this time you know what he'll think is that now the average has come where I had previously left my average, the way the previous average was at 5.5 and I left here. So now I guess it is the time that I should sell at this average, right, because this was the previous average which I had seen, right, so it's better to sell at this average. Or else maybe the previous the previous mentality, the previous fear which I had seen, that from 10 it came to that fall which I had seen, again I'll have to face a fall of that and I'll miss this gain which I have got. So to capture those gains, this person will start selling at this level. So there will be supply out here, there will be huge supplies out here, selling will start and the price will basically again start falling down. Okay, so these are the reasons why it acts as resistance as well as support. Okay, so now let me take a example. Okay, so now this is a stock of Bandhan Bank. I told you the name. If you wish, you guys can also check this chart. This is a chart of Bandhan Bank and this is a current chart only. You don't want to scroll back to the past or something. You'll see this in the 2021 itself. 2021 means in 1 day time frame, just check for the 2021, you'll find this kind of pattern in it. So this is a 100 SMA. Okay, so this is a basically a 100 SMA and this one is a 200 SMA. Yeah, so now here you know what is happening is, if you'll see the same scenario which I told, that this stock is basically showing you a good reversal or a bounce back from these levels. Okay, and on since it is on a day 1 day time frame, it was actually around approximately more than a month or something, 2 months approximately. Okay, so it was showing this range, so it used to go up, again down, again up, again down. So here this 200 moving average was acting as a support and this 100 moving average was acting as a resistance, right? So I hope you guys would have understood from this example that how support and resistance is being um, taken from means it's being managed or it's being supported, right? They are being obeyed in this chart. So basically why this is happening is because of the human mentality only. The person thinks that there was a good huge fall out here, from here the stock fell down, if you'll see, right, this was like if you'll see, this was basically 420 levels, Bandhan Bank was at 420 levels during the month of January basically, and from there the stock started falling down, and it came down to this level. This is basically 300 to 90 levels. Okay, so it came down to this level. So because of this fear, the person who has seen a fall of from 420 to 300, that person's fear, that fear that I wish I would had sold at this level, at this level, at this level, so that fear made him actually to book his profit out at these levels generally, right? So this was a level where he started booking his profit because he thought that maybe again the stock would fall, and that made a fall again at this level. He thought that from here, from this level, maybe there could be a reversal, because this is a 200 days average moving average. So 200 days means if an investor had invested one rupees every day for 200 like for 200 days, right? So that is the average at which the price is basically trading is at that time. So this 200 days will obviously be a very strong support as compared to 400. So like in both the scenarios, when a stock falls, so generally the stocks are like, the moving average are like this. So this is 50, this is 100. I'll explain this again in a very good manner further, that how you will have to see. So this is the general trend. Okay, so if you'll see some safer stocks, right, some large cap safe stocks, you'll see this pattern: 50, 100, then 200, then 150, then 200, like this. You'll see the pattern like this. So generally if a stock starts falling, it first touches this 50. If it breaks this, it goes to 100. If it breaks this, it goes to 200. So here also the same thing happened. First it broke this 100, then it came and it broke this 200, right? So from here it showed a reversal, and then again it was trading in that level. Okay, so basically here the person was thinking that 200 is a very good support. It can act as a very good support as compared to 100 or any other, right? So here it was showing a reversal from here. So you guys, like, again now look, since it broke this 200 level, right? So here below somewhere like around this level there would be 250 or 300 moving average, 250 generally, I guess, right? So from here it showed up again a reversal, and this time the same support which was acting as a support for last few months, now it is acting as a resistance for this. Okay, so now it is acting as a resistance, and currently the stock is somewhere around here. So for you guys, what you need to understand from here, that moving average can also play the role of support and resistance, and we should actually find such opportunities because they give you a very good indication that what could be a level. I'm not saying that it will never break this, but before breaking it will actually try to sustain that level, or to actually like here there was an expectations that maybe it could fall if there were some more green candles. So it could have broken this and gone up, because it was sustaining out here. But unfortunately, like after several days of consolidation, it again showed a good big candle and it fell down. So sometimes it falls down, sometimes it shows a good reverse as well. Okay, so this was the basics of resistance and support. Now let us understand the next concept. So next point is some common moving averages. Look, this is a very common doubt which almost everyone asks me, right? And everyone is confused. Like basically they'll ask me which set of moving average should I use. Okay, so this is a very common doubt for everyone. So from my opinion, what I personally feel is, and till now what I have understood it, is that this moving average reacts how maximum population of traders, like how they are seeing the market. So let's assume if maximum population of traders, they are using, let's assume 20 SMA or 20 EMA, whatever. So if they are using this, then by default automatically only it becomes clear that the direction of movement of most of the traders, if it is based on this 20 SMA, then the market will maybe move as per how they treat it. Like if they say if you are also using that same 20 SMA, and if you predict something, the success ratio of that would be higher, because the other population, the maximum population, is also predicting the same thing based on the same moving average, right? So your prediction will also match their prediction. Okay, so how, just what you need to do is, just like generally what we do is we find out this from all this investors. So ask anyone all the investors, like, just or turn on your business news or something. Even there they keep on telling the whole day, based on this 12 days SMA, or based on this 12 SMA, 20 SMA, let's assume 30 SMA, these are the results which we have got, and we feel that this price can move up. So if those bigger investors on a like on a business channel, if they are using those moving averages, the followers who are following those business channels, right, even they will be following that same. So ultimately, through this chain also, you can determine that which are the common moving averages. Like, this is how I have, like, when I was a student, this was how I used to determine which are the best common moving averages, like, which most of the population are basically determining, right? Because I didn't knew all this, like that, how to find out. I didn't have any friends or someone whom could I ask that what is the moving average that you are using, right? So at those time, the basic way to understand this was just Google it, what are the common ones, whatever you get, and what are the feedbacks received by all the users. Based on that, you'll understand that, okay, this is good. So till now, what I feel is, okay, so look, like, there are some common, like, some use 3 SMA. So 3 means that 3 subset 1, which I've already told. Some go for 7. Okay, some go for 9. Okay, these are currently for intraday ones. So for some will go for 9. There will be some members will be going for 10. Like, 10 is a whole number. Okay, so like, the population who will be using 10 will be obviously more than those of 3, 7, and 9. Right? Some use 12, some use 20. Okay, then some use 30. So these are some general ones which they use, and they are like, this is for 3 candles. If you're using on 3 days, that this is for 3 days. If you're using on 5 minutes, so this is for 15 minutes, 3 candles, and so on. Okay, so here the issue is, in intraday, like, these are generally used by the intraday traders. Okay, so for intraday, here the population is divided. Some would be using this, some would be using this, some would be using this, some they would be using 10, then some would be using 20 or 12, and some would be using 30. So here the population is divided. So from this divided population, you have to find out the common ones. So maybe I can say, like, from my understanding, that being a, like, a good whole number, like 10 is basically a number which is generally preferred, 20 is a number which is generally preferred. So these are some common ones which are being preferred. So yeah, some more traders would be using this as well. And for long term, like, look, for long term, basically the common ones are already defined, because what I have seen, that every investor use the same one. Okay, so 50, 100, right? So for long term, just go with 50. You have 50, you have 100. Okay, so you have 150. Just follow this pattern. You have 200 sometimes, right? So these are the common ones which everyone is using. So for long-term investors, there is not much headaches on which moving average should I opt for. If your current price is moving around 50, and if it falls from 50, then the next you should go for is 100. If it falls from 100, also go for 150, because generally this would be the trend. I'm not saying this will be the trend every time. It depends on market to market. Generally the trend is, this would be 50, this would be 100, this would be 150, this would be 200, like in this manner. Okay, but this is not the case in every scenario. If a market is moving in this direction for, like, for 200 days, let's assume, if you are taking on a daily time frame, and is in this scenario only, sometimes like this, or something like this, right? So if I'll draw a chart like this, a very bad drawing, but anyway, so if I'll draw in something of like this, so in this case, the charts, the moving average, they'll all get like this. You'll see something like this, they are all moving like this. So you'll get confused here. This is the example where the moving average will not be following the rule which I told, that not the rule, like, it's a basic observation that 50 is above, then 100, then 150. But generally in a bullish market, this is the basic trend, and bearish, it's opposite. So 200 will be at the top, then 150. So for bearish, you can, like, understand easily. So for bearish, make this as 200, then comes your 150, then 100, then the last one would be 50. So in bullish, this is the one, In bearish, this is the one. Okay, so what I have seen for common, let's wind up that for common investors, these are the common one for investors, long-term investors. 50, 100, 150, 200. Next is 250. Okay, sometimes they use it. And for intraday, generally we prefer this 10 and this 20. Generally they are the common ones which we prefer. Okay, 30 sometimes, like it comes into swing as well. So 30 sometimes people use it for swing, sometimes you can use for intraday. Like in this is the middle one, and the reason why, like, I don't use the smaller ones. Okay, so like why I'm not using this 3, 7, 9, 12, 15, these. If you'll see the difference, the difference will be very small. Like around if 1 rupees, point 2 rupees, like these much will be the hardly the difference in all of these averages. So why should I go for them, right? Like instead what I can do is I'll take 10 and 20. At least I'll get a good difference in between. But if I'll take 9 and 10, even you'll know that won't be a much difference in 9 and 10. There won't be a much difference in 7 and 9 if I take them, right? Or 10 and 12. So to avoid this, what I can do is I'll take 110, 120, or maybe sometimes 30. So as I told, this can also be used in swing as well. Okay, so for you guys, just follow this. These are the common ones from my side. If you feel that there is something like any other moving average which is more commonly used, which I haven't covered, maybe because every people have their different perspective. As I told you right now, that the majority gets divided. Some, maybe 10% people would be using 9, so they'll message me that 9 should have been included. You should have told to prefer that. So it is basically on the way how you treat it. Ultimately, the levels would not be a much, there won't be a much difference if you use 9 also, or if you use 10 also, or if you use 12 also. There will be a very minute difference in it. So it doesn't matter, because ultimately we'll be taking a zone. So in that zone, maybe the price would fall, or we will predict basis on those zones only. So I'll tell you further also different types of ways in which you can improve your accuracy. So for now, just make your preference on such basis that your these 9, 10, you don't need to scribble everything. And to improve this, what you can do is, one more suggestions what you guys can do is take SMA and EMA both. So basically, like for example, you are doing intraday, and if you are taking 10 SMA and 10 EMA, both should be there, right? So in this manner, what will happen is, even if there is a price gap for SMA and EMA, you will be able to cover that for intraday, right? For in 5 minutes time frame or 15 minutes, whatever is comfortable for you. So try to take SMA and EMA both for this is to just improve your prediction levels. So if you want to improve that, you can go this. And I'm not telling for 10 only, you can go like 20 SMA and 20 EMA, just add 2. So basically, if you are using 10 and 20, total there will be 4 lines on your chart. There should be 4 lines because you are using SMA and EMA both. If you are using 3, 10, 20, and 30, there should be total 6 lines. Don't try to make your chart more like only lines and lines and lines. So avoid number of multiple moving averages. Pick some and just stick to that moving average. Whichever you will stick, all the moving average will give you a good result only. Okay. Okay, so now let us move to the last and the most important topic in terms for moving average. This is generally a doubt which almost everyone has, that when should we use a moving average, right? So for the other part, that is how to use a moving average, I've already showed you that when we were seeing the chart, right? But still again, I'll show you at the end for recap on the complete topics, on all the complete topics, be it how to use it for resistance, support, everything. We'll use it at the end directly in the live chart. So for now, how when to use a moving average. So we have already covered the very first part, and we have seen it in a very good detail way. So we already know that we can use moving average as resistance and support. Okay, so if there is a resistance and support forming on the basis of moving average, that gives us a good signal. The second part is we can use it as during crossovers. Now, what is this crossover? So to understand this crossover, right, you need to understand the basic mood of the market. So till now we know 2 points. We already know this, right? That if this is how a moving average is running, let's take the maximum one. Let's assume this is a 200 days moving average. So if a 200 days moving average is running in this manner, can you predict the overall mood of the market or overall trend of the market? Yeah, definitely. This could be a bullish trend, right? Because if a moving average is going upward, we can say that the overall trend is a bullish trend. The vice versa of this is, let's assume if a stock is for the moving average is falling down in this manner. This is also a 200 SMA. Let's assume, right? So even if this is also a 200 and it's falling, we can say that the overall trend of this market is bearish, right? We know this. And generally I have also told you guys, right, that generally in both the market, right, if it's be it like in a falling market or be it in the other one market, generally in both the cases the charts obey the sequence. So 200, then comes 100, then comes 50, in this manner, right? So 200, 30, this would be the manner. So let's assume that the stock is moving somewhere like this, in this manner. So the very first point which it would hit is this one, right? Then it would hit this one, the 50, then the 100, then the 200, right? So we generally know this trend. This is the overall trend in which the market moves, and the same is for downtrend market as well. So if this is how the downtrend market is coming, first it will have to touch the 50, then the 100, then the 150, then this 200, right? This is how the market will basically move upward. So in both the cases we know this is a general way, right? Now try to understand this in a different manner. Now let's assume this was a bullish trend. Till here this was a bullish trend. So till here, if someone would ask me to draw, let's assume a moving average, so I guess according to me this would be something like this. I'm just assuming I'm that this would be a moving average. Maybe it's a 50 days or 100 days. It doesn't matter. But a moving average will be something like this, right? So just for a good reference, I made it this way, right? Now what happened? Let's assume that there is one more. There, like this was a 50 days SMA and there was a 200 days SMA which was also coming from down like this. Okay, so this was a 250, this was a 200 days SMA. Now generally what will happen here. Now as soon as this reversal starts, this market movement start, this is a 200 days weightage moving average. This moving average will react slowly, right? Because it's of a very good subset of 200 days, right? So it will react very slowly. So this will something be like this. It will go from here in this manner and it would show a crossover like this. Okay, and then it will actually start taking it in this manner. Now this is the actual scenario. Okay, you can check this crossover as well. So here we saw what happened was this was a 50 days moving average and this was a 200 days moving average, right? The below one. Now it showed a crossover. The crossover was basically that the 200 was here, this 50 came and it actually crossed this 200. So generally some people trade on this. So if in a bullish market and all of a sudden bearish market comes, like the stock starts falling, so in this case generally at this point it is advised to sell. Okay, so this is a sell signal which has been given based on this crossover. But I don't use this crossover. Why? I have already given you a reason. The reason is cross moving average is a lagging indicator. Now see what happened here. Basically here, this point, right, this point, if you track this point, this is this candle, right, this candle. So you are getting a sell signal at this point. This is the point where you got a sell signal. But just tell me, is this the correct point of entry? Like it has already shown a good fall till this place, and this lagging indicator is showing you from due to this crossover, it's telling you to sell at this point. So do you think so that this is right? I don't think so, that this is actually right. So other than this, I could have used something else, right, to predict the fall at this level only. Even with this resistance and support, I could have said that yeah, it has to break in this, so I could have taken an entry here only. So this because of this lag in this indicator, I generally don't use this crossover. Okay. So but you should know this. I'm not saying that I'm not using it, so I'll not tell you guys. Also, you should know this. There are several traders out here who actually trade only on crossover. And if you will go for algo trading, right, where basically it's traded on the basis of the general algorithm which is fit there, there these things generally work out there, and that is very common out there, that it is worked on the basis of a crossover, right? So I generally don't trade it. So here this is the point where it actually happened. Now look, just try to understand this. Till now here, this sequence which I told you was being obeyed, right? 200 was here, 50 was there. Again, as soon as this market came after this crossover, again the same pattern started falling, which I told you here. This would be 50, this would be 200. So again, look, this is 50, this is 200. Again that pattern came. So from here we can conclude, right, that this was our good correct study, that here it's obeying 50 and 200, the sequence. As soon as a bearish market came, in bearish market also this one was being obeyed, 50 then 200, right? Now again let's try to understand the second portion of this. So now let's assume that now this here you can see that again a reversal is happening, and from here again a good bullish run is being, we can see a bullish run, right? So generally what will happen, again this would be the scenario here. Like this stock would be moving something like this. Okay, and now again after a certain point it will cross over in the same manner because of this bullish run. And again you can see from here also that again in this scenario as well, this 50 will eventually go up, this 200 will be eventually down. But in both the scenario, this indicator where it actually told me, like, now currently I'm getting a bullish run out here, right? So in this bullish run I should actually buy out here in this point. We You are suggested to buy here, but again this is due to the lagging indicator, it is showing me at a lag. So at this point would be somewhere around here, right? So I have already missed this big run, and I'm already in a overbought zone. So why should I buy at this point, right? It's not correct to buy here, right? So again from here I can say that no, that this is actually a wrong indicator. This is showing me wrong signals basically, right? So I hope you would have understood that when wrong signals basically comes, like why I basically don't use this crossover and why I consider this as a wrong place for entry. Okay, so now let us see some of the common crossovers. Like, I'm not saying that these are the only crossovers which you can use or you should focus on. There are, like, whichever crossover you see, like, you can trade on that. But generally these are some common one which most of the people they prefer. So the very first one is, like, this is for swing trade or long-term trades. So you can go for 50 and 200 moving average. So let's assume that from top, if a 50 crosses a 200, you can say that a bearish market is coming. And then from below, if a 50 crosses the 200, so like in both the side, like this is 200, if a 50 is crossing from here in this manner, right, this means that a bullish run is going to happen. You should buy here. Okay, now let's assume this is a 200 and a 50 crossover is happening from up like this. So here you can say this is a bearish crossover, which means you have to sell in this case, right, and buy in this case, right? So I hope you would have understood this. The other one is 7 and 21. So now comes, these are like for the intraday ones, this and the 12 and 27 or 26 some people take. So these are for intraday traders. So if you are doing for intraday, you can go for this 7 and 21, 12 and 26, 27, whatever. And if you are going for swing or something, you can go for this 5, 200, 5, 50, 200, 50, 100, these kind of crossovers. Okay, so now let us move to the chart. We'll implement the everything from the basic, and we'll try to uh, understand how we actually use moving average in the actual manner, in the practical implementation. Like, because till now everything was based on a theory, and I don't want you guys to only muggle up all these things just for the for the theory purpose. You should actually know how to implement it. Okay, so now we have come back to the charts. Now here you can see this is a chart of Asian Paint, and currently it is in a 1 day time frame. Okay, so first we'll see from 1 day time frame. So as I told you, like I was as I've already told you that whenever you will go for charts, right, and in a longer duration, if you'll try to see that, generally this is the trend in a bullish market. So here, like you can see, this has been a bullish market throughout. So here you can see this trend is obeying very correctly. So here this is your 50 days moving average, this one. Okay, now this one is your 100 days moving average. Okay, you can see here, like as I am hovering out there, you'll see the name as well. This is a 150 days moving average, this is a 200, this is a 200 days moving average, and the below one is 250 days moving average, right? So here this trend is also being obeyed, which I was trying to tell you. Now let's go to 1 day time frame. So now see, this is a 1 day time frame. Okay, so in this 1 day time frame, we'll see that crossover part which I was trying to tell you guys. So here you can see this portion, at this portion basically, here there was a crossover. And can you guys tell me which crossover was it actually? This was a 50 and 100 days crossover. So generally, after this bearish move, fall, right? After this fall, this indicator came a bit late, right? After a good amount of time, a good amount of around 15-20 days later, this showed in the chart. That's why we call it as a lagging indicator. That I know I can see that there was a fall, but this fall, this crossover came a bit late. And from here, if you'll see that if someone had followed this, and if he would have taken any entry, let's assume here, saying that, oh, now this has cut, so I guess I should sell. You can see that from this point, this stock never returned back to this point in this period, right? So if you would have sold here, you would have faced a good loss out here, right? Now let's move to this second crossover. Now here you can see that this crossover is basically at around this level. So here this crossover actually came into life. Now see, for this also the same point is valid, that after this movement, I missed this candle, right? So because this crossover came after this movement, so I have already missed this one opportunity, and this opportunity comes after this. Here this moving crossover was actually successful, because after this point also there was a good movement out here, right? So I'm not saying that every time it fails. Here you can see that in this scenario, if someone would have bought at this place, generally, right, in a bullish run this is for buying, and in a bearish movement this is for sell, right? So here you can see, as here this 50 days moving average gave a crossover to this 100 days moving average from below. So as I have told you, we'll buy here. So here there was a buy, and the people booked a good profit out here at this level. So sometimes it goes into your favor, sometimes it don't go into your favor, because here generally these are lagging indicators, and this crossover actually replicates a bit late, right? It gives you a hint, it gives you a entry point, but that is sometimes it's late. So if you use moving crossover, maybe your accuracy could decrease. So this is the reason why I generally don't use this moving average, because most of the time I focus on developing a good accuracy, right? That's the main focus of my. Also, now the first point which I told you, that resistance and support. So here also you can see that in 1 day time frame also it has shown a reversal from here, and this is almost near to this 50 days SMA. Maybe if I'll put EMA instead of this, it will be directly touching this, right? Because there's not a big difference. If we'll go to, let's say, 1 week, here see, you can see here that at almost all these points they were respecting either the first one or the second one. So if like here it showed a bounce from the 50 days, here it showed a bounce from the 100 days moving average, here it bounced from the 100 days moving average, right? So either from the 100 days moving average or from the 50, if it falls further, you can see it maybe till this level as well, right? So it doesn't matter on it which level generally this is happening, but at whichever level it is happening, we can only conclude that it can bounce back from one of these moving averages, right? So I generally keep SMA. You can keep SMA or EMA, whatever you wish. And also, for beginners, I would suggest you guys to keep SMA and EMA both, so that with the time you can actually compare them, that what's the basic minute difference in it, right? So I hope you would have understood this with a live chart. That's my reason of showing you from a live chart was this only, that you can actually feel it. Now let's go to Hindustan Unilever also. Here also you can see the same scenario, right? Here also, if you will see, uh, from this 50 days moving average, it has shown a bounce. Here it showed a bounce, like here it showed a rejection candle basically from this 100 days moving average. Here again, if you'll see, not exactly from this SMA, maybe it would be from EMA of 100 or something, it showed a bounce, right? So these bounces which you are seeing, right, these are the reasons why we generally consider it for resistance and support. And I'll suggest everyone out here to actually try this out on your own, right? And I just noticed this also, that even if you'll see in this chart of Hindustan Unilever, right, you can see here that in this time frame, this 50 days moving average, right, it has shown a crossover with 100, 200, right? It has shown a crossover with almost most of them, excluding even with 250, I guess. So it has shown a crossover from here. So here if you'll see that this was the point basically where it actually gave you a signal. So even if someone would have entered at this point for buy, right? So even if someone would have entered here, he could have actually gained some points around, right? So I'm not saying that every time this crossover gives you false indications or something. It doesn't gives you a false indication. It's just a lagging indicator. So this bull run, you have missed this one. So generally you miss this one, but you actually capture the other part. If sometimes it comes, sometimes it doesn't. So here your accuracy is not much improved. So now what we'll do is we'll try to understand some of the ways in which we can actually improve our accuracy, because the moving average concepts are clear. Most of the things which are generally used for moving average and how they are used, I have covered most of them from the best of my knowledge. So now we'll try to understand the ways in which basically we can attain a very good accuracy in it. So maybe after that you guys could actually understand, have a better understanding when to use it. So now let's go and discuss some of the better ways of improving accuracy. Okay, so how do we increase our accuracy in trade? Like, this is one of the most common questions which every trader has, that how can he increase his accuracy in the trade? And these are some points like which I had experienced throughout my trading journey, and some points which I have seen that some successful investors they suggest, right? So we'll try to use those points. Before understanding this, like the major part of accuracy, you guys will have to develop a mentality of understanding moving average in layman terms, right? Like, because every time it's not needed that you guys should know the moving average from a like a expert, some a guy from a financial background, he's telling you guys. Like, just take moving average from the human mentality, how it actually works. Okay, so like if you start seeing everything from your daily lives, right, then in that case you would be able to relate them with each other, and in that case your accuracy will improve automatically. Like, I don't have to give you an extra portion of those that do this for increasing it. It will automatically increase. So let's assume I'll just take a small example. I'll cover it up. So let's assume that there are some moving averages like this. So I'm assuming this to be, again, let's assume this is 50, then comes 100, obviously, right? So I'm again taking it in the same manner. Okay, next is, let's assume 200. Okay, so this is 200. Next is 250 or so on. Okay, and we'll just go on so in the same manner. Here let me take one more, that is 30. So this is 30. Okay, now these are the moving average in this manner. Now let's assume this is not a moving average, this is a speed breaker. Not a speed breaker, let's assume this is a police checkpoint. Okay, and you are a guy who is basically driving a bike or something. Okay, and you are trying to come like you are over speed, you are in over speed, and you are trying you are coming here like this. Okay, so basically what will happen. This is a week, like this is a 30 days candle and this is a week candle, because we all know that. Okay, so here there, let's assume there are 30 manpowers out here. They try to stop you. You are a criminal who is trying to flee. So you just came, you will cross this. Let's assume you cross this successfully. So as soon as you will cross this 30 policemen, the next target comes as 250 policemen, let's assume. So there are 50 policemen now to catch this thief. So can I say that the accuracy of getting caught at this point and the accuracy of getting caught at this point are different, and here the probability is more, right? So here if the probability was, let's assume x, here it would be something greater than x, right? Obviously something which is actually greater than x, let's assume it's y, right? So the probability out here is y, which is ultimately greater than x, the probability, right? Now even like, even if you flee this point, this checkpoint is broken. Okay, and now the next checkpoint are of 100 police officers. So 100 police officers are waiting for to catch this thief. So can I say that the accuracy of catching a thief out here, let's assume that's z, this will be more as compared to the previous one, that is y and x. Can I say this, right? Now let's assume again the same scenario happens and you break this. Okay, and you come to this 200 levels, 200 policemen are there. Now they are ready to catch this thief. So now the probability at this range, don't you think so, this will be higher than xyz, all the three, right? This will be the highest one, and 250 will be more highest one, right? So now let's assume that the thief gets caught at this point. Okay, now why did it got caught here? Because of this 200. So generally, now take this back to the market scenario, the market also reacts in the same manner. If a stock don't show you a reversal from 30, the probability of reversal from 50 is increased. If it breaks 50 also, the probability is increased for 100. If it breaks 100 also, the probability of getting reversal from 200 is highest than 250, right? Generally, most of the stocks, like around in 90% cases, you'll only see that the stock has reversed from 200. Right, 250 scenarios hardly they comes, like in 1 or 2% cases only a stock goes to up to 250 and then reverse from there. Generally from 200 it reverses back, right? That too in worst case, because if a stock has fallen down and it came from 30, 50, 100 to up to 200 moving averages, there should be a very good strong bearish trend, then only it can come till there, right? Like this happened during the previous COVID lockdown in the March month 2020, right? So in that 2020 something like this happened, right? So the very first one is the one which I told you, that follow the overall trend of the market and moving average. So if let's assume that the trend of the market, I've already told you this, the trend of the market is, let's assume, in a bullish manner. Okay, the moving average is also going up, right? So in this case we'll never sell, we will never sell. Like if there is a moving average going upward like this and the trend is also going upward, there are no other barriers, there is no sign of reversal, so why would we sell? Okay, so we'll never sell in this case. And the reverse of this is, if a stock is going down, okay, and there are no cases of reversal, we are seeing that daily it is going down and down and down, so in this case we will never buy. Okay, so I hope that you guys have understood that how we should follow this with the overall trend. Whatever trend the market is giving, don't go against that trend. The second one is, if the multiple moving averages are at similar prices or at same prices. So here what was happening was, this 30, 50, this one, this 30, 50, 100, 200, 250. All these were different levels, right, at different prices, and they were in this manner. But let's assume that all these levels are like they are coming together at a similar point, something like this, right? They are coming around at this point. So this point, the place where actually they are all are coming, I'm not saying at a particular point. I'm not saying, it could be in a range, like this could be a range somewhere where they actually came, like this was the gap, and the gap decreased to something like this, right? So in this case, the probability of reversal or but whatever from here is highest, right? So you can trade, you should always trade at such points if you are seeing that most of the moving averages are at similar points, right? So in this case you should actually take an entry, because here the probability that you will fail is very low. The next one is find the odd man out. Now what is this? Like this is a strategy which I had seen most of the investors, they prefer this. And actually if there are some good traders, they will definitely suggest you this out. So find the odd man out. What does this mean is, like, generally those who trade in Nifty and Bank Nifty, they would know this. If let's assume most of the moving averages are trading at this level, let's assume, and one odd guy, an odd let's assume moving average is here. So all the moving averages were at this range, and one odd guy was here. So what will happen is, as soon as the market will start rising from here, right, it will rise from here and it goes up to here. Since all the moving averages were here, there is no like there are no other barriers in between here, so the price will definitely go till this level. The probability of reversal from here is the highest out here. Means in first attempt, at least I can say that in 90 or 95% cases, it will definitely reverse from here. And in the very first attempt, maybe in the second attempt, it would like cross this. I'm not saying, like, the same is for these also. Okay, so that if a price is falling and it falls from 30 to 50 to 100, like it keeps on falling, then in the very first attempt from 200 it can show a reversal, right? In the second attempt maybe it could break it, but in the very first attempt the probability is always higher. So here in this first attempt the probability is very much high that it will fall down. Okay, so we should always search for these kind of opportunities in the market. I mean, and I'm not saying that you will not find this. You can find this multiple moving average in almost all stocks. The stock, like, if you'll even just go a bit back in my video, you'll see that in the Hindustan Unilever also there was a point where all the moving averages were coming at a similar place, right? So this happens in all the stocks. Okay, and this find odd man out also, I have seen that most of the time it actually happens, right? So if there is something like this, that if you get a chance to see such stocks where one moving average or two is excluded and it is somewhere above as compared to the other ones, all 50, 100, 200, everything is down. Let's assume one 10 or 20 SMA is at this level. Okay, so this is 10 and all the other ones 50 to 200, all the other ones are here. So in this case, even this is a very small moving average also, you will see a reversal. So I have hope that you guys would have understood how to increase your accuracy. Like, you just try to find out these points, and other than this, you guys should actually try to develop a healthy mindset, because the more you could actually try to understand the human nature, how they actually treat it, uh, the more easily you can predict it, the more easily you can actually understand the market, and your accuracy will increase obviously in that case as well. So I hope this moving average session was helpful for you guys. You would have understood everything clearly. If there are some doubts, please feel free to mention it in the comment box. So that's it for the day. We'll meet you in the next session. Till then, have a nice day. Thank you.